Hello and welcome. This is the Crypto Culture Crew. Thank you guys for tuning in. This is a part two of our terms and vocabulary for cryptocurrencies. If you guys liked the last video, like and subscribe to this one. I'll be sure to give you guys more content. With that being said, let's get right into it. So last time we finished off with wallet. So now let's get into market cap. So market cap really just describes the total value of a particular cryptocurrency. The easiest way for me to actually show you guys would actually be go to coin market cap. That's actually where I get a lot of my info. So coin market cap here, if you look here, if you look at market cap, every single cryptocurrency has a market cap, which is basically the price multiplied by the number of outstanding coins or token. Here, for example, Bitcoin has a market cap of basically 750 billion, and in circulation right now, there's about 18 million or 18.7 million Bitcoin, and that's how they get you that market cap total. Now, with that being said, when you're trying to make your investments, you do want to look at market cap because the higher the market cap, the less chances of rug pulls and being scammed there are because there's actually a lot of different people in the market. Also, with that being said, you can still suffer from market manipulation with any of these cryptocurrencies because there are large holders of certain currencies that we talked about before. They're called whales who actually just have these currencies, and based on how they trade and use their currencies, they can actually try to manipulate the market like that. So let's look at Ethereum next, 300 billion. Now, if you look at Ethereum here, now the market cap for Ethereum again is based off of the price times the outstanding circulating supply. Now, Bitcoin has a fixed supply, whereas Ethereum right now has a supply that can increase. They are going to be switching to a deflationary style where now tokens are going to be being burned after a certain amount of usage for each transactions. That's happening with EIP 1559. That's supposed to be rolling out in July. And what that actually should do is make it more valuable because now it's deflationary. It's going to be less and less of Ethereum versus more and more, and then being able just to make whatever they wanted. So that's kind of how market cap is looked at. And if you look at the top two right here, almost 100 billion is in, 1 trillion is in Bitcoin and Ethereum combined. And if you look up here, the total market cap of cryptos, I'm not sure if this is correct, is showing at 1.2 trillion. I think just the other day it was at 1.5, but that could be the case because there was been a lot of selling of altcoins and people are actually buying more Bitcoin. So that's why you see the market cap going up as well. Our next term that we're going to go over is going to be token supply. Just touched on that briefly as well. Token supply, again, we could look at Ethereum or right here, circulating supply. So this is the number of Ethereum coins or tokens that are currently in the market for sale or for trade and things like that. Now, what you also have to keep into account is when you're going onto like a Coinbase or certain exchanges, most people who have tokens or coins on that are actually trying to sell those at some point and make a profit. Now, what a lot of people do is they take those tokens or coins for Ethereum, for example, and they actually take them off of the exchanges and they put them onto hard wallets or other type of devices where they can actually, because they don't plan on selling them anytime soon, hold them, and then sometimes you can even stake them as well. We'll get into staking as well. The next term we're going to go over is tokenomics. Tokenomics is really important when you're trying to make an investment or a purchase in a particular currency because the tokenomics will determine basically what happens with that supply of coins. We can look at Cardano, for example. Right now, it says that the circulating supply is 31.95 billion. So let's see if we can go on their website and see what their tokenomics are. Here, Doesn't really say, but usually on the white paper, it'll actually outline the tokenomics. So tokenomics is basically how a particular coin is going to be distributed. So usually when a coin is first made, the developers will actually, let's say they create a million of a certain coin, for example. They'll take usually half of those coins and they will either put them aside for like development or to go to certain investors, and maybe the other half they'll actually sell on like a public auction for other people to buy and things like that. So if we look at tokenomics here in crypto, let's see if they give us a definition here. It says the topic of understanding the supply and demand characteristics of cryptocurrencies in the traditional economy. Economists monitor the issuance of a currency using official money supply data. These numbers are these numbers help to enable transparency and monitoring of different aspects of supply of a currency. So what you're looking for specifically though, if you're looking at a tokenomics, you want to figure out if all the coins that have been made are actually in supply. Because if there's only half of them that are actually in supply and in circulation, that means when the other half enters the market, it actually could dilute the market because now there's more than there was before, and then lower the value of that particular coin. So you want to take a look at that as well. A lot of tokens, what they do when they first come out is they'll have a roadmap where 25% is going to be issued maybe in the first 2 or 3 years, and then another 25% in the next 2 years. So that way they don't all hit the market at the same time and lower the value for the existing holders of those particular coins or tokens. Next, we're going to look at CeFi. So CeFi is just basically a short term of centralized finance. Centralized finance, as it's described here, is centralized finance is used to be the standard for trading crypto before DeFi came into the picture. It still maintains a stronghold over the cryptocurrency industry, but decentralized finance is catching up with it as DeFi is seeing outstanding growth this year through its yield farming trends. We'll get into yield farming a little bit later. In centralized finance, also known as CeFi, all orders in the crypto trade are channeled through a centralized exchange. The funds are managed by responsible people running the exchange. This means you don't own a private key that gives you access to your wallet. Furthermore, the exchange determines which coins they list for trading or how much fees you have to pay to trade using their exchange. To summarize this section, you don't truly own your cryptocurrencies when you trade via a centralized exchange. Moreover, you are subject to the rules and centralized exchange imposes on you. For example, Coinbase is a centralized exchange. They tell you what coins you can or cannot buy on their exchange. They charge you fees for those things as well, along with Binance. So those are two examples of centralized finance and centralized exchanges. Now, if we're looking at the next example, DeFi or decentralized finance, that is where it's not being held by an exchange. It's actually being done by a site, and let's use, for example, Uniswap. Uniswap is a decentralized exchange, which is a place where you can actually buy and sell some of your coins or tokens on their website without having to use a centralized exchange. So if you go to Uniswap, you can see here, you can actually click on it, and you do need a MetaMask wallet in order to interact with the site. But having that wallet holds your coins, and with that wallet, you actually do own your own keys. So you are the only person who has access to it. So that's why when they say not your keys, not your crypto, that means that if you don't own the private key, you don't have access. Well, you don't really have access to that, and you can't move the money around as you choose to. This is why a lot of people do like decentralized finance and decentralized exchanges, because they can do whatever they want. There's no subject to any rules that they might have on a Coinbase or a Binance and things like that. Next, whales. So we talked about that briefly. A whale is a large holder of a particular coin or token. Now, typically, when somebody says whales, they're talking about Bitcoin. There are a lot of Bitcoin whales out there, and they actually have the power to manipulate the market using their existing Bitcoin as leverage. So if we do Bitcoin whales, we can do a Bitcoin whales list. Let's see what pops up here. So since Bitcoin is on the blockchain and it's public, you can actually see how much a person is actually holding in their wallet. Even though you don't have access to it, it will let you to see it. So it says there are 1,000 Bitcoin whales. What are they and how are they affecting cryptocurrency prices? There are 1,000 individuals known as whales who own over 40% of the market. So 40% of Bitcoin holders is of the Bitcoin market cap is being held by these 1,000 Bitcoin whales. And if they all actually collude and work together, they can really move the market in drastic ways. Now that's going to change as the total market cap for Bitcoin and crypto increases overall. But right now, you can still see a lot of market manipulation and a lot of just different ways that they're actually trying to affect the market. And they're allowed to because they own so much of it. And if they all work together, they can move the market in certain directions. That's why you see certain flash crashes and things like that happen because, they have the power to do that. Our next term we're getting into is going to be dollar cost averaging. Dollar cost averaging is a term and a way to actually invest. So if you're new to crypto and you're trying to, get into crypto, I highly, highly recommend dollar cost averaging. So dollar cost averaging is when, let's say, for example, right now, Bitcoin is at $40,000. Let's say you wanted to get into Bitcoin, right? You wanted to get into cryptocurrency. You have $1,000 that you want to spend. What most people will do is they'll take that $1,000 and then they'll go buy Bitcoin, Ethereum, Binance, or what any other coin that they are interested in purchasing. Now, while that is one way to do it, what you really want to do is try to spread that thousand out. To me, I would say, again, this is not financial advice, just a financial opinion. Spread that out over 4 different buys. So spend 250 on your first buy, 250 on your next, and 250 on your third, and so on and so forth. The reason why you want to do that, because let's say Bitcoin today is at 40,000. By the way, we did have a pretty big jump in the Bitcoin price over the past 24 hours. If you click on Bitcoin, for example, and then the chart will load, let's take a look in the past 1 month what Bitcoin has done. So right now, if you bought it at 40,000, just Saturday it was at 35,000. So if you were to go spend all your money, your $1,000, and spend it on $40,000, $1,000 worth of Bitcoin at 40,000, and then let's say the price of Bitcoin tomorrow drops to 35,000, you could actually have lost some of the money that you had put in. Versus if you spend 250 today and then tomorrow it drops to 35, you spend 250 there, and then let's say in a week you buy another 250 and the price at that time is 38,000. The average price over that buy is going to be lower than if you would have just bought it all at one time. And if you are dollar cost averaging, what you really want to do is instead of maybe just buying at a certain time, you want to buy when you see a big decrease in the market. So if we look here, 31,000 on June 8th. So last Tuesday, if you would have bought on June 8th, you could have gotten Bitcoin at 32,000. That's a dip. Over here, 34,000. Over here, 32,000. So if you are buying dips now, you're going to be able to get a lower cost of Bitcoin versus just buying it all at one time. For example, let's say you would have bought even just about a month ago, Bitcoin was at 49,000. If you had took your $1,000 and you put it all in at 49,000, now even though it's at 40,000, you're still at less than what you would have had if you maybe would have dollar cost averaged. Let's say you had that $1,000 and you put 250 worth at 49,000, and then you waited and you saw this dip here, right? And you put in another 250 and you would have got it at 35,000, and you see another dip here, 34,000. Now your average cost is going to be lower than if you would have just bought it all at one time at 49,000. So dollar cost averaging is a great way to invest, and especially if you're going to be getting into crypto for the long term, that's to me the easiest and the best way to try to make some money in the cryptocurrency. So now let's take a look at the next one, buying the dip. I just basically just went over that, but this I'll just go over real quick again. Buying the dip is when you see dips in the market, and again, let's look at a longer period now, 3 months. This is the Bitcoin chart. You want to try to buy when you see the market is down. Now, obviously, when the market is down, that means a lot of people are selling. So it takes a lot of conviction to buy when everyone else is selling. But that's the best way to invest in any type of market. You don't want to be buying when it's at its peak. If you would have bought in April and you would have bought it at 64,000 versus right now when the market is down at 32,000, that's about a 50% difference. So you want to buy the dips. You don't want to be buying when it's at its all-time highs. You want to wait until you find a good spot to get in, and getting in is actually more important than getting out. When you actually get into a certain coin or crypto, that's really going to determine how much you're actually going to make. Now, over the long term, even if you had bought Bitcoin at 62,000, if you're going to hold over the next 2, 3, 4 years over the bear market, there's going to be another cycle for a bull market. That 62,000 may seem expensive, but if you have the conviction to hold for 3 or 4 years, that 62,000 in the next bull market could be 100,000 or 200,000. So although sometimes you may get in at the wrong time, if you are investing in the long term, you can definitely still make some money, but you just have to have the conviction to actually hold through that period. Next, let's talk about Telegram. So Telegram is a social media app that is used by a lot of different people in the crypto space. If you are getting into crypto, I would definitely recommend getting Telegram because a lot of different coins do a lot of communication with Telegram. So if you're looking to get into crypto, learn more about crypto, definitely want to get this app, sign up, follow your favorite coin, get in the community, chat with people. You're going to be able to learn a lot more with your Telegram than just kind of going through the internet. Cryptocurrency uses a lot of new social media technologies really to communicate and educate and interact with its users base and the clientele. So Telegram is definitely one that you want to look into. I believe the next one on the list that I'm going over is Discord. Discord is another way that people can communicate and talk into a certain community. Certain coins do have a Discord where you can join and really just engage with the community. Again, if you're really trying to get into crypto and learn about crypto, I would highly recommend that you download Discord, join a certain Discord for whatever coin or community that you want to get involved with, and you can really learn a lot in that community. Now, with Telegram and Discord, any of these, and even YouTube, you want to be really careful about certain sites and things that you visit because there are a lot of scammers in all of these different places because people are looking to take advantage. So my advice to you is when you're engaging, never obviously give anybody your wallet key phrase, passwords, or anything like that. If it sounds too good to be true, it probably is. So just keep that in mind as you are trying to learn and engage with any given community. Next, Twitter. Twitter is actually, I think, one of the most used social media sites in crypto. A lot of people do like to interact on Twitter. Some of your favorite YouTubers will use Twitter as well, and talk to their fans and things like that. Coins have Twitters. It's Cardano, Bitcoin, Doge. There's definitely a lot of different Twitter sites and things like that you can interact with and really learn and get really time sensitive stuff. A lot of crypto news breaks first on Twitter before you see it on YouTube or anywhere else. So again, if you're trying to really learn, get a Twitter, start following certain coins, and things like that, you may be able to get some information that you can use to your advantage. Next is staking. So staking is very similar to, let's say, dividends. If you know about stocks, then you can understand staking probably a little bit easier. So staking, you can have a certain coin, and they will actually give you a little bit more of a certain coin by staking. I think Coinbase does do some staking. So look right here, what is staking in crypto? Crypto staking refers to locking up a digital asset to act as a validator in a decentralized crypto network to ensure the integrity, security, continuity of the network. As an incentive for helping secure the network, stakers or validators are rewarded with newly minted cryptocurrencies. So depending on what crypto that you're dealing with, you can stake it and they'll actually reward you. Let's say, I know for example, you can stake your Cardano on Exodus, which is a digital wallet where you can hold your Cardano. So if you wanted to, let's say, have 100 Cardano and then you have it in Exodus and you stake it, they'll actually give you a little bit of Cardano as like a reward and incentive for doing that. Right now, I believe the rate is around 4%. Earlier this year, it was as high as 7 or 8%. The more people that stake it, the lower the returns are going to be. But you're getting a little bit of cryptocurrency just for having and staking it. Now, while your currency is staked, it is locked up, so you can't access it right away, but you can unstake it and then do what you want to do with it, whether it's send it or trade it or sell it, whatever you want it to do. So staking is a great way to get a little bit of passive income from your cryptocurrencies. So you could definitely look into that. I know Solana is another one that's being staked. So you can, I think staking.com is something that actually tells you which cryptos are, what interest you're getting, let's say, for example, on a certain type of crypto. And as you can see right here, it's telling you, but yeah, you can definitely look that up as well and see what coins are the best to stake and which one's going to give you the highest return. As we get into our next term, mining. Mining is similar to staking, except you do need a computer software, whether it's going to be a graphics card or a ASIC type of miner, where you are literally the validator on a network. So blocks are being created in the blockchain by miners. And since they are creating these blocks, the actual network is rewarding them in that cryptocurrency for that service. So the miners are paid a reward for basically maintaining and running the network. So if you ever wanted to get into mining right now, it's extremely difficult because the cost of graphics cards and mining rigs and things like that are super expensive. But miners are literally creating new blocks for a network and literally letting the transactions happen on a case by case basis. Bitcoin has mining, Ethereum has mining. There's a lot of different cryptos that do have mining that help service their actual network. So that's what mining is. Next, we're looking at decentralized exchanges. We talked about that briefly before. You have Uniswap is a decentralized exchange. There are actually a few other decentralized exchanges that you can use as well, but I believe right now that is the most popular because it is on the Ethereum network. So again, you can use decentralized exchanges to buy or sell cryptocurrencies without having to go to Coinbase or Binance and things like that. Liquidity providers is really important because that's how decentralized exchanges are able to actually service their customers. Liquidity provider, let's say you have Ethereum, right? And you have, let's say, 2 Ethereum. You can literally take your Ethereum and pair it with, let's say, a coin that is not very popular, Spark Point, for example. So now, anytime somebody wanted to buy Spark Point on a decentralized exchange, the decentralized exchange needs somewhere to actually get that particular coin from. So as a liquidity provider, you're actually putting up your Ethereum and your Spark point as a way that people can now use that to exchange, buy, and sell, and you're actually paid a small percentage for that service. The more you own of a certain liquidity pool, the more that you actually get paid out. So liquidity providers are essential for a decentralized exchange, and they really can't work without it. This one here, shitcoin, is a term that's used by people when they believe a coin is just junk and it really doesn't have any value. If you go to CoinMarketCap and you look, let's say, at cryptocurrencies, anything here in the top 100 would not be considered in that category. But once you get to, let's say, like page 57, of this, these are coins that you've never heard of or probably don't know of, and they don't really have a lot of value. If you look here, certain of these coins they don't even have market caps. There's so little money into them that they don't even have market caps. So you got to be very, very aware of these types of coins because yes, they may promise you huge returns, but if no one is using it, then how are you going to get those returns? So you do want to be very, very careful when using that as well. Next, we have fundamental analysis. Fundamental analysis is a way to look at the market, see the market, understand the market. For me, I do use a lot of fundamental analysis. That just means, like, for example, El Salvador recently, I think last week, just announced that they would be using Bitcoin as legal tender. That is fundamental news. That is huge for the crypto space because now you have a whole country that is adopting Bitcoin as currency, and it's actually less important that El Salvador did it, but what's more important is that they were the first ones to do it. And if you're looking at the whole crypto space, there won't be the last. So this was a big step. So now you're literally waiting for the next country to try to adopt this and this policy. So everyone's going to be watching El Salvador over the next few months, years, seeing how their economy and their monetary system is going to work using Bitcoin as a legal tender. That's one example of fundamental analysis as well. Fundamental analysis is also looking at the market cap, seeing how much money is in the actual market and different news like that. Things that will actually have like real big news, like for example, Ethereum going deflationary in July after EIP 5059. Bitcoin also announced that they're coming out with a way to actually interact with smart contracts called Taproot. These are really big fundamental news, and sometimes the fundamental news has no effect on the market just because of certain sentiments and things like that. But it is a good way to kind of gauge what's going on in the crypto space. Next, we have technical analysis. So with technical analysis, you're going to be looking a lot more at charts and things like that. So TA, or technical analysis as they call it, people will actually chart out different coins, and they will actually use that as indicators on how they're going to trade or invest in the market depending on different ups and downs. Now, you can use these charts, but there are way more technical charts that will actually show you where you can actually draw lines and channels and you know catch moving averages and all those things. And a lot of people do use technical analysis to make their investments versus fundamental analysis. But I do believe the best way to do it is to do a mixture of both. You're looking at technical. Obviously, if you see the market going down like this may be a good spot to get in because you believe it's going to go back up. But the thing about technical analysis, it works until it doesn't work because at the end of the day, the market is the market. It's going to do what it wants to do. But when you're looking at technical analysis, you're looking at the history of movements in the market, and you're using that to kind of determine what you think is going to happen next, and you're going to respond accordingly. Next, Fibonacci levels is another form of technical analysis. If you look at that here, it's actually used in stock markets as well. Give you a quick definition. Why is the Fibonacci sequence so important? Let's take a look at that. Fibonacci sequence is significant because of the so-called golden ratio of 1.618, or its inverse 0.618 in the Fibonacci sequence. Any given number is approximately 1.618 times the preceding number, ignoring the first few numbers. So this is more technical, more use of things like that. Fibonacci was actually a mathematician who created this Fibonacci sequence that people still use to this day. So that's just another form of technical analysis that people use as well. Next, it's not sentiment. It's actually supposed to be sentiment. So sentiment is actually just how people feel about the market. What are people feeling like? Are they feeling like cryptocurrency is in a good space right now? Do they feel like the market's going up? Are they scared? Do they feel like it's going to go to zero? Are they trying to sell? So sentiment is really probably one of the most important things, because how people feel is going to determine their decisions. If you're getting great fundamental news, fundamental analysis, and things like that, but then all of a sudden you see that people aren't feeling that that's great news. It doesn't even matter if the news is great, because people don't feel that it's great, and you'll see the market go down. So sentiment is a big part of how people feel about the market, and that actually goes into the next term, which is the fear and greed index. If you're looking at the fear and greed index, let's see if we can get that. Fear and greed. So again, it's part of investor sentiment, where how people feel. So we can click on crypto fear and greed index here, and we could actually take a look and see what people are currently feeling about the market and things like that. So right now, the level is at 28, which means there's a lot of fear in the market right now. People aren't just buying a whole bunch of cryptos and things like that. They're actually worried that it may go down and things like that. So, the lower the score, I guess, here, the more people have fear. And then once we're getting over here in the green, this is where the greed sets in. This is where you're getting a lot of FOMO, people just hopping in the market. We were there earlier this year, and then now we've had a nice pullback, and that's why you're seeing the fear. So those are the terms that I just wanted to go over with you guys today. Thank you for watching this video. If you like it, please, just like or comment, get in the comments and tell me what you think about it. My next video, we're probably going to go over how to use certain exchanges if you're getting new into crypto and you just want to learn how to, invest a little bit and learn a little about it. But again, thank you so much for watching, and I'll catch you guys next time.